Hello and welcome back. Let's explore fixed income securities, issuers, returns, risks, maturities, coupons, seniority, and contingency impacts. In this lesson, we're going to see fixed income securities, their types of issuers, what their features are in terms of returns, the basic relationship regarding the risk and return profile with reference to credit risk, their maturities, how their coupons are set, their profile of seniority, and how some contingency provisions affect their profile. Just a quick heads up before we begin. Make sure you have the notes and the slides ready to go. Not all debt instruments are fixed income securities. In this course, we're going to talk about securities, in particular debt securities, also known as bonds or fixed income securities. For example, a loan is a debt or fixed income instrument, whereas bonds or fixed income securities are a type of standardized debt instruments usually engraved in a formal agreement between issuers and investors. In a bond, an investor purchases a security by paying the seller an amount of money. We'll see that the seller can either be the issuer on the primary market or another investor on the secondary market, in exchange for the promise of a periodic coupon and the repayment of the security par value at a specified maturity. These periodic payments are the distinguishing feature from another type of securities, equity. Equities, also known as stocks or shares, pay out dividends. These payments are not contractually agreed upon, as opposed to coupons. Dividends from equity are not contractually binding. They're discretionary and variable in nature, and failure to pay them out doesn't imply a breach of contract or default in the financial jargon. Dividends are income distributions derived from equity investments, whereas coupons are interest payments from debt investments. The final payment from the issuer at maturity can be referred to as the principal, the face or the par value. During the life of the bond, periodic coupons in the form of payments are paid to the bond holders. Usually, these coupons can either be annual, for a yearly payment, semi-annual, or quarterly. The issuers, the legal entities that sell the securities, can be governments, corporations, or supranational organizations, like the World Bank. Government bonds are backed by the full faith of the sovereign states they represent, with the fiscal power to guarantee payments considered by investors risk-free or quasi-risk-free assets. Whereas corporate issuers for corporations are deemed riskier in general because of the lack of fiscal power. Debt securities are usually classified into different maturity segments, ranging from a few days up to several decades. Debt instruments with maturities shorter than 1 year are also known as money market securities, whilst longer-dated bonds can have also maturities up to 100 years. Coupons can either be based on fixed rates or on variable rates, with the latter being called floating-rate notes or floating-rate bonds, whereas a fixed-rate bond is straightforward, with its stated or quoted annual rates being, for example, 5% or 8% being paid yearly, or semi-annually or quarterly. Generally, floating-rate bonds payments are given by a market reference rate, like 6-month Euribor, for example, plus a quoted spread. In the case of a fixed-rate bond with a 6% coupon paid semi-annually, the issuer pays 3% every 6 months. In the case of a floating-rate bond with a 3-month Euribor plus 2% paid quarterly, the coupon is reset every quarter with reference to the market quotation for Euribor. If, for example, at the time of issuance, the market reference rate, 3-month Euribor, is quoted at 2.5%, the first coupon, which will be paid after 3 months, will be 2.5 plus the quoted spread of 2% divided by 4, that is 1.125%. The coupons for floating-rate bonds are normally set in advance and settled in arrears, meaning the interest rate is determined at the beginning of the annual, semi-annual or quarterly period, but is paid at the end of the period. With corporate bonds, another feature is the seniority in debt repayment, in case of bankruptcy liquidation, with senior bonds having priority over junior or subordinated bonds. One final feature with reference to bonds is the presence of embedded options, namely call, put, or convertible characteristics. In a callable bond, the issuer has the option to redeem the bond on predefined terms before maturity. In a puttable bond, the holder can sell back to the issuer the bond before maturity at predetermined conditions, whereas in a convertible bond, the holder can exchange the bond for a predetermined amount of stock before maturity. There are two fundamental yield measures for evaluating bonds. One is the current yield, given by the ratio of the annual coupon payments and the current bond price. The other, much more common as opposed to the former, is yield to maturity, which is the internal rate of return computed using the current bond's price and the future cash flows, coupons, and par value at maturity. We'll dedicate a specific portion for its interpretation and its calculation. Suffice it to say, for now, that yield to maturity, YTM, is the return you can expect to earn if you hold a bond until it matures, under certain conditions. It considers the bond's current price, its face value, the interest payments, coupons you will receive, and the time remaining until maturity. YTM is expressed as an annual percentage rate and helps investors compare the potential returns of different bonds, factoring in all future cash flows. Besides, if a bond's currently trading below its par value, it's traded at a discount. Its yield to maturity is higher than its coupon rate, because the positive difference between the face value at redemption and the current price adds to the, in this case, stated coupon rate, if the bond is held to maturity. And vice versa, if a bond's price is above par, we say that it's trading at a premium. The negative difference between the face value at maturity and the current price is subtracted from the stated coupon rate if the bond is held to maturity. Sometimes issuers have many outstanding bonds with different maturities, and the relationship between the different maturities and the yields to maturity is called yield curve and is represented visually in a chart. We'll dedicate a specific portion in the curriculum to this topic as well. For instance, considering government bonds like US Treasuries or UK gilts or German bunds. The yield curve is most of the time, but not always, upward sloping, meaning that investors demand a higher return to compensate for the longer maturities. Besides, using the yield curve, one can compare other corporate bond issues with government bonds to measure the compensation demanded by investors for bearing the credit risk associated. A typical bond's cash flow structure is the one of a bullet bond. The issuers make periodic payments to bondholders, with one final lump payment comprising the last coupon and the face value. A variation of the bullet bond is the zero coupon bond, where there's no periodic payment of coupons. All the interest is paid upon maturity when the principal is paid back. Zero coupon bonds work as discount debt securities that are purchased by the investor at a discount versus the par value being paid back at maturity. Some bonds are structured as amortizing bonds. That is, a proportion of the face value is amortized with a cash flow schedule similar to the one of a mortgage loan. A fully amortizing bond has level periodic payments, and just like in a mortgage loan, there are an interest and a principal component. In this lesson, we've covered the fundamentals of fixed income securities, including their issuers, returns, risks, maturities, and coupon structures. Understanding these elements is crucial for navigating the fixed income market effectively. As we move forward, we'll delve deeper into these concepts, providing you with the tools to analyze and manage fixed income investments proficiently. Make sure you've downloaded the slides and the notes if you haven't already. And don't forget to tackle the questions at the end of this lesson to strengthen your understanding. In the next lesson, we will explore the complex world of fixed income markets, where issuers like governments and corporations raise capital and investors seek predictable returns and risk mitigation. We'll understand the roles of various market participants, trading mechanisms, and factors influencing price discovery.